coming up on Retiring Well with Michael Reese.
That is not the only number that you're paying, that there are other expenses that you pay that are completely hidden, that are significant, and you need to take them into account. All that matters is, and what we're going to find out, all that matters is what does your beneficiary statement say? That rules everything with one exception, and you want to know the exception. That means if she does that, as you know, she has more control over her money. She has the availability to invest in anything, right? She can do whatever she wants. It's all in one place, all online, really easy to manage.
Now, the host of Retiring Well, Michael Reese.
Welcome to the show today. We have 30 minutes of action-packed information specifically designed for you. Retiring Well starts right here, right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
This week in CFP Talk, we're talking about mutual funds and the fees that you pay when you invest in mutual funds. Now, as you know, millions of Americans put their money in mutual funds, and hey, you might be one of them. The question that you want to ask yourself whenever you invest your hard-earned dollars in mutual funds is you want to know, what are you paying them to manage your money? And not, what are all the fees, not just the ones that you see. Are there other fees that you don't see? Well, that's what we want to talk about today. So in a recent study regarding mutual funds, the average fee, the average expense ratio of a mutual fund here in the United States is about 0.90%. So what does that mean? Let's say that you are looking at ABC Mutual Fund or XYZ Mutual Fund, and you open up the prospectus. The prospectus is that document that they give you before you invest, and you want to do your due diligence. So you open that prospectus up and you read it, and it says right there in the prospectus, oh look, your expense ratio, the amount that you pay the advisor every single year is 0.9%. Now, you're never going to see that anywhere other than the prospectus. You won't see it on a statement or anywhere else, but it's there in the prospectus. And so you think to yourself, well, that's not so bad. That's less than 1%. And as a certified financial planner, I would tell you, if you're paying less than 1% on your investments, that's a reasonable rate. I would give you an A grade on that. But here's the problem, and here's what this study taught us. And this study, by the way, came out in 2011, so we're talking like 5 years now. They taught us that that is not the only number that you're paying, that there are other expenses that you pay that are completely hidden, that are significant, and you need to take them into account when you're investing your money. So here's what the study told us. This was a study that was written about in Forbes, written about in Barron's, I think Investors Business Daily, all the big publications talked about this when it came out in 11. So here's what they said. The first thing you have to watch out for are these things called transaction costs. So transaction costs. What are transaction costs? That is what a mutual fund pays to buy and sell the different positions. And there are a number of transaction costs. There are the cost, the actual cost that the mutual fund company pays to buy and to sell. There is a spread, which is the difference between what they're buying or what they're paying versus what the other side is buying or selling for. There are things like when a mutual fund, a big mutual fund sells shares, they might sell 1 million shares in any company at any one time. And when they do that, that affects the markets negatively, and so you end up getting less of a return. But if you add all these murky transaction costs up, on average, 1.44%. That's what you're paying each and every year on average. Some years more, some years less. We're talking about the average fund. And obviously, some funds are going to cost more, some are going to cost less. This is just average. The next level of cost you got to watch out for is something called cash drag. What the heck is that? Well, whenever you invest in a mutual fund, there's always a certain percentage of your money that's just sitting there in cash. But you're paying your fees on the whole thing, And so on average, that costs 0.83% when all the numbers are crunched. Now add all this up, 0.9, 144, 0.83. 3.19% per year is what you're typically paying in the average fund. And we're missing two things. Loads/advisory fees, and in after-tax accounts, taxes. Folks, this mutual fund you think costs less than 1% could end up costing 4% a year when all of this is said and done. Know your costs. Now, if you have any questions about this, or anything that we talked about here, please feel free to give us a call. We are happy to help you out.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The big three being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. Learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, September 21st and September 28th at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. Again, that number is 231-995-1700. The class code is 4319 and the class is called Retirement Secrets.
Well, this week, as you can tell, we've got Banks here. She just keeps getting bigger. I thought it'd be a good idea to check in and see how she's doing with her sector investing, because if you've been watching the show, you know, about 4 to 6 weeks ago, we had her pick some sectors to invest in. And we wanted to see, you know, maybe she'd be better at this. We started off having her try to pick a stock, and, you know, she didn't do so well on that one. So we thought maybe that's just too much for her. So we tried sector investing. So I'm going to go ahead and take a minute. Let's go ahead and roll about a minute of that film. So you all, if you didn't see this, so you can watch Bank pick her sectors. Oh, she smells it. All right. First one she picked was cash. That's the first right now. Oh, there she goes. She went for gold. All right, puppy, there you go. Gold it is. So we have cash and we have gold. Apparently, Banks is going defensive on us. So, you know, all right, we're back. So, as you can see, when she picked the sectors, due to her choice of dog treats, I guess, she ended up picking cash and gold. Well, let's see how my baby Banks here is doing so far. So I've got the results here in front of me. Here we go. Over the last 4 to 6 weeks. I'm recording this about a month after she picked them, by the way. So after the first month, cash, well, you know what that's earning. Nothing. right? No, nothing for cash, banks. And then gold, gold is up 0.74%. So if you would have taken your money and put half of it in cash and half of it in gold, which of course you would never want to do, but let's imagine you did, for the month you'd be up 0.37%, or that's about 4.5% per year is what that works out to be. So that's not so shabby. Let's see how the other sectors did that my baby here did not pick. Yeah, you chose. So she did not pick. Here's what she didn't pick. She didn't pick U.S. stocks. Well, guess what? Those are up 0.44%, so those are doing okay. She did not pick international stocks. Now, that was a mistake. International stocks are up 2.5% for the month since we did this. I mean, that's amazing. But then she also did not pick real estate. Now, this may come as a surprise to you, but real estate's actually down 3%, 3.22. She did not pick the healthcare sector. Now, I know a lot of you, especially if you're retired, you are big fans of the healthcare sector because it's done so well historically. And I know you're thinking, healthcare is just going to be used more and more, and with an aging population, all the advances, that's where the money is. Well, guess what? That sector's down 3.5% in the last month. So if you do the math, if you were to put your money in U.S. stocks, international stocks, real estate, and healthcare, say 25% in each of those categories, you'd be down almost 1%, 0.92%, so which is the equivalent of being down 11% for the whole year. So basically, my girl here, she picked cash and gold. Let's be honest, we made a little fun of her, right? She picked cash and gold, but she actually picked the winners. Overall, her portfolio of cash and gold, after a whole month of measurement, you never measure anything after a month, of course, but we do on the show for my baby banks, she is beating the other sectors quite handily so far. Now, we're going to kind of check in on this from time to time. I know she was a little depressed when she picked Nike and it didn't beat Warren Buffett's investing, so she's a little down on that. But now, with this approach, maybe she's doing a little better, and maybe she'll give us some fun additional picks as the year goes on. So folks, if you have questions on some of these topics, questions about anything, always feel free to give us a call.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Thursday, September 22nd at the Inn at Bay Harbor in Petoskey. Tuesday, September 27th at Otsego Club in Gaylord. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com/events to reserve your seats today. There's no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
All right, this week we have got a great beneficiary blender to share with you, but here's the thing. This kind of stuff that we're going to talk about happens all the time. All the time. And especially we see it when you encounter a situation where you have maybe someone's been divorced, maybe it's a second marriage, but we even see it in first marriages when you have accounts that have been around a long time. Now, what's really happening here is this. A lot of times people just like you don't clearly understand the priority in which accounts are transferred when you die. And what I mean by that is a lot of times you think, well, I'll just change my will or I'll just change my trust and that's going to take care of everything. Well, my friends, not so fast. I've got a great article to share with you about why that's not necessarily true. All right. The title of this article says, A Spouse's Right to Life Insurance Money. Now, in this article, they are specifically talking about life insurance death benefits. But I want to share something with you. Life insurance, 401ks, 403bs, IRAs, 457s, all those accounts, annuities, you name a beneficiary in that account. And that beneficiary designation is top of the line. It rules. It doesn't matter what your will says. It doesn't matter what your trust says. It doesn't matter what you verbally told people or what you've written down. None of that matters. All that matters is, and what we're going to find out, all that matters is what does your beneficiary statement say. That rules everything with one exception, and you want to know the exception. So here the article starts out. I just want to read a little bit of this, not too much. It says, much to your surprise, you find out that someone else is the beneficiary of your spouse's life insurance policy. So in other words, your husband dies or your wife dies, and you're not the beneficiary. I mean, don't you have an automatic right to your spouse's life insurance or 401k or IRA or annuity? Don't you have an automatic right as a spouse? That's what they say. Not so fast. What they say here is, and this is very, very true, they say that you can exclude a spouse. Whoops, got to turn one more page. It says, you can leave the entire death benefit to someone else. The contract owner determines where the money goes. So, or the contract owner of the life insurance, contract owner of the annuity, or the account holder of a 401k or an IRA. Now, what happened is there have been a number of lawsuits about this. Because they gave an example here. They say sometimes an ex-spouse is left on an old life insurance policy. In other words, here's what happens. Warren Hillman, in this example, had a life insurance policy at work. It was worth $124,000. He died at the age of 66, but the beneficiary on that policy was not his wife, Jacqueline Hillman. So what happened was he used to be married to someone named Judy. Judy was the beneficiary on that policy. He died. He never changed beneficiaries. Now his will, his trust, everything said, no, my new wife Jackie gets everything. Who'd the insurance money pay out? Where his will and trust said the money should go, or what the beneficiary said? They paid it out to the beneficiary. Well, they paid it out to Judy. Well, Jackie, not happy, sues. And then lawsuit. Eventually it goes to the Supreme Court. The Supreme Court ruled 9-0. 9-0. They don't rule 9-0 on anything. And they said 9-0, money goes to the beneficiary. You know what? There's been another case called Kennedy versus DuPont. Exact same circumstance, except this was a 401k. And again, they ruled 9-0, it goes to the beneficiary. How about that? So here's the thing you want to know. Community property states are a little different. There are some different rules there, and there are 9 community property states in this country. So if you live there, you need to know what those rules are. But generally speaking, check your beneficiary designations. Folks, if you have questions about this or anything else we talk about on the show, please feel free to give us a call.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Since 2000, we have seen the market drop to half its value a couple of times. We are now in the second largest bull run of all time. Is the bear poised to strike again? Many are speculating that it is, but we are not going to take that position. The truth is, no one can predict when because they always come unexpected. The key is being positioned to handle it no matter what happens.
By objective, a mutual fund will hold the securities it said that they would hold in the prospectus. For example, a large cap mutual fund is going to hold large company stocks. If the market crashes like it did in 2008, then what does that large cap mutual fund do? Think about it. Will they go to cash?
You will be hard-pressed to find a large cap mutual fund that did not go right down with the market. Don't be caught being passively invested like that. What you want is active management. You want someone managing the downside as well as the upside. Also, don't get caught in the buy and hold trap. You have to remember that in 2008, when the market crashed, it started in December of 2007 and ended in March of 2009. Think about it. That was a 15-month period. Every month, people were getting their statements and they would ask their advisor what they should do.
And what was the mantra? Just hold. It always comes back. Sure it did, almost 4 years after it hit its bottom. We think that is unacceptable. It is also critical to understand what you are paying in fees. It continues to amaze us how little people understand what they are paying.
There are only two ways to grow a portfolio. One is by the interest and dividends being earned by the underlying securities, or what we call yield. And two, by appreciation, the idea that a security will grow in value. If I'm trying to grow to get a 6 or 7% return, and I'm only getting 2% in yield, and I'm paying fees of more than that, then my whole portfolio is relying on speculation. That's where you get volatility. We have all been taught you can't have great reward without taking great risk. It is not true. You can achieve market-like returns without volatility.
We have the tools today to show you how much risk you are taking. We have the tools today to show you how much you are paying in fees. Don't you think you have the right to know? To the first 10 callers, we will perform a risk and fee analysis for you absolutely free. If you had a life-threatening illness and the doctor was prescribing a critical procedure, well, wouldn't you find it appropriate to get a second opinion? You have saved retirement your whole life. Don't you think your life savings deserves a second opinion as well? Again, for the first 10 callers, we will do the risk and fee analysis and we'll show you how to avoid being just passively invested. Give us a call.
Welcome to this week's edition of Coffee Talk with Mike. My name is James Curry. I'm one of the financial advisors here at Centennial Wealth Advisory. We've got some great questions from viewers this week for you, Mike. Are you ready for this week's questions?
I'm ready. Fire away.
All right. First, we have a question from Sandra in Austin. She writes, I have a 401k at a former employer. Is it okay to just leave it there?
Oh, well, this is one of those things we have all the time, right? Someone is working at one employer, then they go on to another employer, sometimes a third and a fourth. And a lot of times that happens. It's natural that people just, when you go to a new employer, you're not thinking, okay, what do I do with my 401k, right? You're thinking, well, wait a minute, I'm just trying to get to this new job. So is it a good idea to leave the money at your old employer? As we talk about this, I think there's a couple reasons why you probably don't want to do that. Number one is just lack of control, right? You only have certain investment options there. You don't have, tons and tons of choices. And so you don't really have, maybe you have access to it online, but you're not connected with the administrative staff as much anymore. It's just kind of a pain. What I really encourage Sandra to do, and Sandra, if you're watching this, I really want you just to call the office and let's sit down and talk about this. What I would really like to see her do is just open up an IRA. It's just her own personal IRA. And that way, every time she's at a job, if she moves on to another employer, she can use that IRA as kind of where all the old 401ks can kind of come in one after another and accumulate all in one place. That means if she does that, as you know, she has more control over her money. She has the availability to invest in anything, right? She can do whatever she wants. It's all in one place, all online, really easy to manage. And it just makes the organization of her finances a lot better. So folks, if that's happening to you, if you're in the same position as Sandra, yeah, just open up your own IRA and start, kind of consolidate those old 401ks into one place.
Yeah, it'll make it easier to just have one account instead of so many different ones like we see a lot of people have.
Oh yeah, that's for sure. It makes my mind think back to when you put together these reports for people and they've got all these accounts and you're just, what a mess, right?
Next question we have from Jerry in Lago Vista. Jerry writes, my IRA is finally back above its high point. I'm worried that markets will go down soon. How can I figure out how much exposure I have to losses if that happens?
Wow, that's another good one today. So James, is it fair to say that we're getting a lot of people coming in with the same kind of thinking?
Oh yeah, absolutely, with markets near all-time highs.
Right, and they're seeing their accounts, they're like, oh man, I finally got back to my, I finally have more money in here than I've ever had, right? And then, but what if the markets drop? How much could I lose again? It's frustrating when you work so hard and wait so long to see your accounts get back up to their high level, and then bang, there goes a market crash and you lose everything again. This is one of those areas and a lot of people ask this question. It's another reason I really, really want people to come visit with us because, as you know, you guys are always running Morningstar reports where you're plugging a portfolio into Morningstar, a third-party vendor. And what you're doing is you're helping the folks that come visit identify, look, if the markets go south, here's how much you can lose. And tell me, James, is it fair to say that a lot of times people could maybe lose a lot more than they think?
Absolutely. A lot of times people are taking a lot more risk than they think they are, and that downside can come a lot quicker than they can when markets go down.
Isn't that the true where markets, they kind of go up slow, but man, when they drop, they just crash, don't they? So one of the things that for anyone who's, if you're at home, you're thinking, man, I've got the same kind of question. Look, that's a reason to give us a shout because we want you to come in. James, the rest of the team, they can run that analysis for you and help you really identify, what your exposure is to losses. And you need a program like Morningstar, something along those lines, to really, truly, independently, objectively identify for you what the risk is that you're taking, right?
Well, that was certainly some great information this week, Mike. And for anyone else watching that might have any questions, please feel free to call the office or visit the website and we'll answer your question next.
Thanks everyone for watching the show today. Now, if you have any questions, feel free to call our office or visit our website. And remember, you only retire once. So let's get it right the first time. We'll see you next week.